Check, check, check. Oh my goodness, there we go. Can you all hear me now? Hi. Judith, can you hear me now? She wrote in, said there's no sound. I think I had a button muted on my end. I was saying very enthusiastically that I'm excited about some new technology that we have, and then it failed me. And Judith says she's confirming. Thank you very much. This technology is going to enable us to create a much more engaging production as we do this weekly YouTube show, and it's going to allow us to branch out a lot more. One of the cool things I can do, watch this. If I click Judith right here, we can bring her comment up. We can put him on the screen. There's Mark. I can put his comment on the screen. We can engage with you guys and make the lives much more bi-directional so that we can kind of have a conversation. Otherwise, we may as well just do a video and send it out, right? But the whole purpose of live is so that we can engage with each other. So blow up the chat pane, have fun with it today. I'll post them as I have opportunities to do so. I also wanted to let you know when I was muted that Scott Landers is dealing with a medical issue with his parents. If you've been around Scott for any amount of time, you know that his parents are very elderly. I believe his dad is in his 90s, and something popped up this morning, and he just had to go deal with it. So I don't believe it's an emergency per se, but that's why Scott's not here. We know and we love him, and we're excited to have him back next week. So with that said, I wanted to primarily use this opportunity to make sure that all of this technology is working, to see how you guys are engaging with it and enjoying it, and also to jump in and do some market updates. There's a lot of interesting things going on in the market right now. So let's hop on over here to the charts. This is the S&P 500. And of course, if you've been with us for any amount of time, you know, and not living under a rock, you know that we've been in a predominantly bearish trend since the beginning of the year on the S&P 500. What I want to point out is this most recent move, though. We came up and hit resistance, came on down. We bounced off this Fibonacci box, and everybody kind of collectively held their breath right here and said, could this be the bottom? We made a higher high and a higher low, and everybody was getting maybe a little bit overly optimistic that we were heading in a bullish direction. But you guys knew better. If you're part of the TradeSmart University community, you knew that until we got through this red box, that Fibonacci box, that we were still technically in a confirmed downtrend. And of course, we came right to that box and we headed on down just to our point of support. In fact, we had one day that we shot past it, and then we came on back up. Now the question is, where are we going from here? We'll come back to that in just a second because there's a lot of interesting information out there about things going on over the big pond, over in Europe right now. But what I wanted to point out before we get there is just how monumental the last week of trading has been. If I pull up the stochastic here, which is for easy conception right now, it's just a measurement of when stocks, or in this case an ETF, are overbought and oversold. And somebody was being, they were getting confused on this earlier in one of our classes this week, and they thought oversold meant like it was going to keep going oversold. And that's not the case at all. Now, don't get me wrong, stocks that are oversold can remain oversold, and stocks that are overbought can remain overbought. But it's kind of like if you had too much gasoline, let's just go with gasoline. It's the first thing that popped in my head. And you sold too much of it, right? Maybe the price had gotten so low that, boom, you sold too much of it. What's inevitably going to happen at that gas station? It's going to run out of gas. And it can't remain oversold indefinitely. Oh, I got to put this on Do Not Disturb. That's the sweet love of my life. Focus mode, Do Not Disturb. Learning new technologies all the time. And so the colloquial wisdom here is that if something is oversold, that it's not going to remain in that state forever. And indeed, we can go back and look over time and say, in fact, let's just use our crosshairs here. When we became oversold back in June, what happened? Stocks went up, or in this case, the S&P 500 went up. That's oversold. Down here, we kind of hovered around oversold for a while, but we got a little bit of a bump up. Right here, we're oversold, and we got a little head fake and then a nice bump up. And you can go back and do this on your charts as well. In fact, I encourage you to do that. Just pull up a stochastic indicator and see when it gets below 20, even in the face of this extraordinary bearish trend, we're still seeing that when we get oversold, we tend to take a breather. But what I want to point out here is the last week of trading, with one little hiccup exception. This was, let's actually measure it. From the time we went oversold to the time we got back up into our middle was 27 trading days. Even if we give ourselves the benefit of the doubt and we say, well, we did pop up for a little bit right here, even though it didn't do much. As soon as we got back oversold again, this is 13 trading days that we remained oversold. I had to look far and wide to see when we had been 13 days oversold. In fact, this is the big coronavirus crash. We'll probably get delisted from YouTube for saying that. Oops. The big C crash right here, that was only 13 bars itself. What did I just say recently? I can't even remember. Can't remember what happened 5 minutes ago. Right there. Also 13, maybe 14 bars. So you've got to go all the way back to 2020 before you saw stochastic that was that oversold. And then look what happened. We launched into one of the fastest recoveries that the market has ever seen. I challenge you to go back and find other ones. Let's see how close this was. I don't think it was even 13 days. Yeah, that's 11 days. This was probably the 2009 or 2018. Yeah, 2018 going into 2019. Those of you that were trading at the time, you probably remember that. This was end of year, and then the big crash going into the beginning of 2019. This felt cataclysmic back then. It's like child's play now. And you can do a little study for yourself and say, well, when we get in this situation in the past, well, past performance isn't indicative of future results. Things kind of rhyme a little bit, which reminds me, I meant to put a disclaimer up here and we didn't do it. So let's just do it right now and remind us all that this is for educational purposes only. All examples and analysis are intended for that purpose and should not be considered specific investment or trading advice. So back when we were consolidating around support here and we were so oversold for so long, I posted on the TSU Discord, those of you that are members of TradeSmart University, and I said, this is a pretty dandy time to think about buying into whatever. And I chose SPY to buy. I like trading SPY because I think it's more stable and not quite as surprising as some individual stocks can be. It gave us a little bit of a scare, a little bit of a head fake right there. But I held true to my trade and my convictions. My stop was not achieved, and then we took off, and it was a grand and glorious day. Not Thursday, not Wednesday, but Tuesday. Tuesday for me was a 3R trading day. Now, if you're just new to TradeSmart and this idea of R's is unfamiliar to you, basically what I'm saying here is I did in one day what I would expect to do in a week and a half of trading. It was a big day, just nice shot up there. And so one of our instructors says, when the market makes money available to you, take it. And so I was happy with that. I put the 3R cash in my jeans and we moved on. Of course, the market came back, it reset the next day. We're kind of hovering around there today. And the question is, how do we build a framework around where we're at right now, which leads us back to our green box. I'm a fan of Fibonacci analysis. Without making this an hour-long YouTube live, my opinion on fibs is that the ratio that Fibonacci analysis is based on is all around us. It's called the golden ratio, in fact. And because of that, life tends to follow this rhythm tied to the golden ratio. And it's uncanny. You can see here where we came down and we bounced in this green box. That's a Fibonacci box. We came up and bounced in the red box. That's a Fibonacci box. Go look at the previous YouTube lives that we've done on Thursdays, and you will see the creation of those boxes before, that's the key, before the candlesticks got there. Anybody can draw lines historically, but when you start forecasting into the future, that makes you a real trading stud. And so what I want to figure out is where we might come up to, and actually this box needs to turn red, because as long as we trade to or within but not beyond that red box, then we are still technically in a bearish trend. As long as we trade to or within but not above this red box, then we must maintain a bearish perspective on our directional bias in the market. Now, I say that not because I want you to bring a bias to the market. I'm saying that because ultimately, at the end of the day, we've got to figure out how to make a trading decision, which means the weight of the evidence, the probability of a certain outcome needs to convince us of a certain direction. So grabbing our Fibonacci tool here, I'm going to use this white candle. I know that may seem unusual to some of you. Why I would use that candle instead of the black candle, trust me, is for very, very specific reasons. We could geek out on fibs for a long time. In fact, maybe I'll do that. I'll do a 4-hour YouTube live and we'll talk about fibs. But based on my experience, this is going to give us a preferred result. And I could say succinctly that this white candle is when we know that we bottomed out and we turned on up. It's also right around where all this support was happening previously. So on September 30th, I think that was an anomaly on the last trading day of the month is what was happening there. And it's not necessarily the right candle to measure our analysis from. The white candle is a much better selection in my opinion. Then I came up here and I'm using the bottom of this dark candle right there. And the reason I'm using that is because it's the same candlestick we used to establish this green box and that red box. And as the saying goes, if it ain't broke, don't fix it. Those were perfect bounces of support and then also again as resistance. So there's something significant about that price point, and we're able to use what we've learned in the past and apply it to our current forecasting. So as you can see, once those measurements are drawn, we've got these 3 green lines that go right across my screen. I make it simple and I just draw a box around the whole thing. We could get more nerdy if you want, but I have found that more nerdy doesn't actually mean more cash in our jeans. So we're going to keep it very, very simple right now. As long as we trade to or within, but not above the red box, then we're still in a bearish perspective. And that's what I have in mind. I do have one bullish trade open. I'm hoping to be out of it either today or tomorrow. By the way, I don't know if are my audio levels clipping. I just got a message that it's a little bit hot here. Let me pull that down a little bit. You're welcome to chat in the YouTube live. I can see your chats as they come in, and if it's something extraordinary that you said, we'll even publish it for the whole world to see here. It'll be cool. But as long as we trade to or within, but not above the red box, we've got to remain in a bearish position. So now we kind of have a crisis of events here, don't we? We've got this situation where we're so oversold, we really needed the market to relax a little bit and come back on up in this bullish trend. We did that. We put the cash in our jeans. Let's not get greedy about all of that. But at the same time, this stochastic is heading on up. And I'm telling you, friends, if that coincides with a bounce off from this box and stochastic coming up even near 80, I wouldn't even have to necessarily see it break through 80. But if it got up there and started heading on down, I think there's an opportunity for a bearish play ahead. Let's riff on that for a second longer, and then I'll come talk to you guys about the trade that I'm in right now. Actually, I'll show it to you guys in case it's a good entry, because I was looking at it right before class, and it's an interesting entry. This is McDonald's. And I was looking for a bullish trade to complement what I was seeing in the overall market, but something that might be a little bit resistant to the S&P selling off and not necessarily tanking itself. And I came across McDonald's here, not to confuse boxes, but if I draw a box around this, let me color this differently so that nobody confuses this. We'll make it yellow because I really just want to highlight here. That's what the purpose is. Since 2021, April, a year and a half ago, McDonald's has just been back and forth in this box. In fact, if we go back even further, where is now support has been strong resistance in the past as well. That's not to say that Apple cannot break through this box, but this is a very good opportunity to place a pretty well-defined stop. If we get down here, then there's a good chance that Apple's going down. So the delta between the entry and where our stop is, that's our exposure on this particular trade. And there's an opportunity to manage our risk on the downside. But if it were to pop back up and go into this box, I'd say you've got at least a 2-for-1, if not a 3-for-1 risk-reward ratio there. So right where the green line is, I entered a trade. We're just a little bit underwater on it right now. I entered this trade yesterday. Pop into a 15-minute chart here and just watch. I was probably right about here yesterday when I entered this trade, and it took on off. Now we're back down a little bit. We'll see. It's not a huge position because of my position sizing based on the size of that stop. But if the market were to get a little bit of a last burst of bullishness, I think there could be an opportunity in McDonald's to put some cash in our jeans. I'm not overly optimistic from the long-term bullish perspective. And by long-term, I mean like going into the new year. And here's why. I don't know if y'all have been watching the news or if it's even hit the news yet here in America. But if you guys been watching, there's my my wife texting again. I thought I put that on Do Not Disturb. You know what? She has given herself permission to come through the Do Not Disturb. Hopefully she doesn't send any of those messages. And that could get spicy on YouTube Live. Oh, goodness. Side note, not to get distracted here, I always leave my phone on Do Not Disturb, candidly, because I want to talk to people on my timeline. And, you know, it's so busy with all the spammers and stuff that try to call you. I'm like, I will look at my text messages and look at my voicemails when I want to keep from being distracted all the time. And so Jen was like, I feel like I can never message you because it's always on Do Not Disturb. And I said, well, sweetheart, just take yourself off Do Not Disturb. Like, you can make an exception for somebody. So she did that. But now with this new technology we're using, those messages are coming through. On Zoom, it doesn't publish those messages. So there you have it, some behind the scenes look. That and about $100,000 will buy you a tank of gas these days. All right, so here's what's going on, and it's interesting to me. Credit Suisse, or how do other people say it? I say Credit Suisse. Credit Suisse, is that how they say it fancy overseas? They're in a little bit of trouble. And I may put together some more research on this and publish it in the Discord channel. But it's starting to sound a little bit like Lehman Brothers. Like, they're calling people up on a Saturday saying, hey, you know, no reason to fear. I just wanted to let you know that that everything's okay. Have a great weekend. And then, of course, what do all the clients that have Credit Suisse accounts do? They fear. They freak the heck out. And so to some extent, even though perhaps their financial stability is not as bad as public perception has it right now, they're kind of inciting this public panic about what's going on with one of the world's largest banks. I apologize, I didn't say that. I'm not sure if that was clear. Credit Suisse is a world bank, and it's deemed one of the necessary financial institutions, which brings back to memory, somebody type it in the chat pane. You remember what it was in 2008? What was the mantra? Buzz said, let me see how I do this here. Oops, I got to click this other one. Buzz says, for $10 a week, I won't say a word, Josh. Buzz, I think I'd set my standard a little bit higher. I think you could probably get $150 a week at least. The rumblings that are on the street are too big to fail. And they're talking about bailouts. And so one of the smart people that I track, that I pay a stupid amount of cash for them to speak into my trading life. One of the ideas that's out there is money is exiting the European economy at an extraordinary pace, and they're putting it in the US economy because they perceive it to be safer. Suisse. Okay, it's pronounced Suisse. I'm not cultured like y'all, so Credit Suisse. And so when you get, just think buyers and sellers, when you get an influx of cash that's coming into the US stock market, what happens? It tends to drive the price up. But if there's an end to when that cash influx is coming in, then the idea here is about the time, probably, that we're getting up near this red box, which, by the way, could coincide very nicely with this downtrend that's going on. About the time that we get there, we could start seeing the buying dry up, and then we continue on down. If we start seeing financial institutions start being bailed out by governments again, it could be another 2008 situation. For those of you that have been attending faithfully all these YouTube lives, you'll notice that's a change in tone. From the very beginning, I have been saying, this is not that. And it hasn't been. This is not the mortgage collapse of 2007, where they were over lending. But leave it to Credit Suisse. They figured out how to do that. And the way that we're able to determine this is going to give PTSD to some of you, not to make light of PTSD, those that are really suffering from it. This is just money. We can get over money. But now they're starting to analyze all the credit default swaps. And I don't know if you remember how credit default swaps work. Got to dig back to our 2008 brain. But essentially, when a bank sells a loan, you guys know how that works. You get your mortgage, and then you got it with SunTrust, and next thing you know, Bank of America's got it. When the bank sells the loan, the person buying the loan goes out and buys insurance on that loan, depending on their risk mitigation principles, saying that are based on how likely they think the loan is to default. And so a bank goes out, they get a $250,000 mortgage that they acquire on their books because they're going to get paid the interest. They will in turn go out and buy a $5,000 insurance policy on that from another bank that says, sure, we'll guarantee that you get the $250. And I'm making up, or $250,000. I'm making up these numbers, but the principle is how it works. We'll guarantee that you get your money back. It's a way to reduce your risk. And in exchange, you're going to pay us a fee. It's like an insurance policy for banks. That's a credit default swap. If they default on the credit, we're going to swap this out. You give us our premium, and you get the bogus loan. And what we're seeing with Credit Suisse is these credit default swaps are starting to spike on up. That means the people that they're selling these loans to don't have a very high certainty that they're actually going to get paid back, which is the beginning of starting to sound like 2008. So all is not lost. Let's take a look at what that felt like back then. By the way, get a mental snapshot, if you will, of this picture. Let me go to SPX because I don't have as much drawing on that. Same thing, just index versus the ETF. We don't need any of this here. Just want a clean sheet. Just take a look here. All right. And experts have been saying this could be a wave 1, a wave 3, and a wave 5. Now, the tricky thing about wave 3s and wave 5s are they can have multiples. So it can look like 1, 2, 3, 4, 5. Wave 3 and wave 5 can have extensions. That's Elliott wave theory for those of you that want to burn a few brain cells on that. So notice the head and shoulders pattern. I just deleted it right after I drew it. Notice the head and shoulders pattern, the testing of the shoulder. We came down, we've come back up, we made a lower high than the shoulder, and we're heading on back down. Going back a few years. Friends, does it not look a lot like we could be sitting right about here? If history is rhyming with itself. That's what we could be looking at. Now, here's the good news. Well, the good news is we can all make money when the market's going down, right? If not, send us an email, info@tradesmartu.com right away, and we will make sure that you get that figured out. But from a time perspective, to get to that point was 281 bars, 406 days, a little over a year to get to where that fifth wave really kicked in. And then going forward, it was only 130 bars, 130 trading days until the bottom. I'm not saying that we're going to see this aggressive of a move. It could be much more tame than that. I would like to think we learned some things from 2007, 2008. But whether this goes out like a lion or whether it goes out like a lamb, I think that we could be, from a calendar perspective, we could be approaching the end of this crash of 2022. From a price perspective, we could take the slide down. We'll make it a curly slide. We could be taking the slide down. There's a saying in the stock market, the stocks take the stairs up and the elevator down. The elevator may be getting ready to ding and take us on down. I hope not. I really hope that y'all come back to this in 6 months and you're like, you were wrong, Josh. You don't know what you're talking about. My self-esteem is strong, and you're welcome to do that. I hope I'm wrong. I hope that this is starting to look like a double bottom, or maybe we try again and we get a bit of an inverse head and shoulders pattern and it takes off. I don't know. Here's the best guidance that I can give you. Coming back to where we started, as long as we trade to or within, but not above that red box, then further bearish momentum is definitely in the cards. We need to be prepared for it. Any questions right now? I'll take a brief pause. My wife made me this beautiful green drink. Can you all see that from my Red Robin glass? I had that since college, y'all. It's got like a little piece of history. I'm on this new lifestyle. You can't really say that today, too, because that could be misinterpreted. But some people call it a diet. I call it a lifestyle. Buzz, I wish I had a better answer for you. My employer doesn't give me a 401k. I don't know what all the rules and regulations are there. Are you able to trade your 401k, and do you have rules around that? And here's the other thing that I will say. Cash is always an option. So if you can't trade it, you can go to cash. If you are able to trade it, I would be very, very conservative. I get a little bit hanky when people start talking about trading in the style that we trade. When they start talking about trading fortunes, and by fortunes I mean your retirement, and that could be $200,000 or $2 million. There's a difference between investing and trading, and I don't know your age, Buzz. I mean, I think I kind of do because we've had previous conversations, but even if it crashes, given a year or two, there's a good chance that we'll make back a lot of that. So let's set some of those fears at ease as well. In 2009, let's see how long it took to get back there. Where's 50? So within less than 1 year, 50% of it had come back. Did I do that right? I'm not doing that right. How do I do that? I'll just have to eyeball it. but that's about 50% of the way back up. And that took a year. And then to get all the way back up, it took 2.5 years to get there, almost 3 years. So, okay, I won't publish your age on the big YouTube. Depending on what you're planning on doing, I would imagine that you've got a few more years before you're wanting to really tap into that 401k. So again, this is not trading advice, but if we started to break through and go lower, cash is an option. And if you could buy, some puts with like a fraction of your account, so if you're trading a $200,000 account, maybe like 10,000 of that you could use for put options. That's going to, put the rest in cash. That's going to at least help you feel like you're not missing out on the move and you're not losing ground. But at the same time, if you lose 10 grand on a $200,000 portfolio, okay, 5%, that's just, in this market, that's just a bad month. So that's a off the top of my head strategy to kind of guide you in a direction. In and out of ETFs only. To get to cash, you got to buy bonds. So the bonds market has been weird. It's been kind of going parallel with the market. Normally it goes inverse. So if I could only trade an ETF, I wonder if you could hedge by buying like half of your portfolio with long SPY and half your portfolio with SPXL or X. What's the inverse? It's SPX. It's a 3X. SH is one that I've been trading. Ticker symbol SH. There are issues with inverse ETFs over the long term. So if you start holding on to this for a long time, it gets a little bit wonky the way that it works, especially leveraged ETFs. But short term, that could be an interesting option. Yeah, and dollar cost averaging. Normally, I'm not a fan of that from an investing perspective, or excuse me, from a trading perspective, but from an investing perspective, I think there could be a lot of wisdom to that. Buzz, you know how to get in touch with us, and depending on what the size of your account is that you're talking about, don't publish it in here. I have people that I can put you in touch with. Not me, because I don't manage people's money. That would be a conflict of interest. But I have individuals that I trust, and if you wanted to have a conversation with them, most of them start with $1 million estates and go up from there. But if it's less than that, we could find somebody to put you in touch with as well. You're welcome. All right. Moving forward, I can see in my reactions, somebody gave me a thumbs down. Are you still here, thumbs downer? I'd love to know what you, maybe they didn't like the potential that the markets could be going back down again. All right. Coming back to Credit Suisse, whether it pulls out of this downtrend or not, I don't know. There's part of me that's tempted to sell some naked puts on this. Of course, a naked put means you have to buy the stock. So if it goes to zero, it goes to zero, but it's also only at $4. So your maximum risk is you've got to buy it for $4 and it's worth zero. So you're out $400 for that option contract. On the plus side, if it goes up, you're just going to keep the money from the put. And also, by the way, if it only goes down to like $3.50, then you just own the shares. You paid $1.50 more for them than you could have. So I haven't checked to see what the option pricing is, but that's another interesting play, because my thinking process is, and if we go back to, Lehman Brothers, and I guess they actually went out of business, but Fannie Mae, Freddie Mac, they're still doing business. The government bailed them out, GM, all of that. If the government's going to put the weight of their dollars behind it, the likelihood that it goes out of business is much, much lower. Enron went out of business, and there was a lot of people that thought they were getting a great deal on shares until they went to zero. So, let's not forget that going out of business is an option. All right. A couple more things to look at. This is just for my personal edification. Keeping an eye on the VIX. Of course, the VIX typically works inversely to the S&P 500. So as the VIX gets extremely high, we're expecting the S&P to go low. And as the VIX comes on back down, there's an opportunity for it to go higher. So the VIX is reset a little bit today. It's still really high compared to where we used to be. I remember the days pre-COVID when, a high VIX was 20. Now today, a low VIX is 20. So I don't think there's a lot to see there. I wouldn't be surprised if the market just kind of trades blah into the weekend. We're sitting here. This really is consolidation right now. And, to counterbalance a rather bearish outlook, this could be a little bit of a wedge pattern, which is a continuation pattern in chart patterns. So we come up, we kind of consolidate, and then typically head up. I've got my eyes on that red box as a target. Oops. Awesome. You're welcome, Buzz. All right. I'm good cutting this one here. We don't have the stock Landers in the house to share his words of wisdom as well, so we can wrap up a little bit early, unless you guys have some questions. I've enjoyed hanging out with y'all today. What do y'all think of the new YouTube Direct platform? I'll show you some of the things we can do with this. So when Scott's here, actually I don't have this set up, but when Scott's here, that kind of worked. I'll be able to bring in his feed. His video will be right above mine. Of course, we got the full screen. We got that. And there's a lot of other things that we're going to be able to do as well, which is going to be very, very cool. I think you guys are about 5 seconds delayed from where I'm at. So I'll let that final thought get out there. Otherwise, we'll wrap it up. I hope you guys use this information to put fat stacks of cash in your jeans. Remember, y'all, when we do good, we're able to do well. So go out and make a bunch of money and bless those that are around you. I will see you guys same time, same place next week. Take care, y'all.